Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. There's a lot of uncertainty in the stock market right now, and we've seen what's happening with the US tariffs. One day he's on, one day he's off, one day he's saying, oh yeah, the stock market is going higher and we're going to do everything to maintain it. Next minute he's fighting, picking a fight with Japan and Korea, and the stocks are tanking. There's so many things going on, but you know what? For us as a long-term investors, this is a great opportunity to do a research, not just to buy blindly. And I'm just going to tell you just a small story. I don't want to share everything, but I just want to let you guys know, please be careful. And the reason I said that is because I've been doing this where, this thing where I'm asked investors to message me their portfolios. So subscriber portfolio reviews, which is you can get access to, by the way, the spreadsheet on my Patreon account. And a brother shared a story with me, and there's two sections. You give me your story, what you're doing, where you're heading, all of that stuff, how long you've been investing, and then you show me your portfolio, and then I give you feedback. And thank you for everyone who shared so far. And this brother was very honest, and he shared something that I genuinely thought is worth just sharing bit of it. And the reason I do that is because I want to make sure that all of you are focusing on your long-term goals. The brother has lost a lot of money. He said he started investing in sort of a penny stocks, quite speculative stocks, in 2022. And since then, he's been down a lot and just trying to basically average down, and he's never recovered. And then he jumped from one penny stock or hype stock to another one, where he thought, you know what, I can get my money back if I did this. Long story short, he still has not recovered his money, initial investment, and he's lost a lot of money. And right now he's basically said, you know what, I want to focus on long-term investment. I want to focus on Sharia compliant, basically investing. I want to focus on a lot of things. And I'm genuinely happy that he's actually now realized this is what he needs to do. And because remember, I'm not a financial advisor, but all I'm saying is investing in things like ETFs, where you got 200, 300 stocks in one ticker. If one of those tickers go down, or one of these companies go down, you're losing just a fraction of whatever you've invested in comparison to losing. If Broadcom becomes basically obsolete tonight, goes out of the, literally disappears, I'm losing over £7,000. That is a lot of money to me. It is a lot of money. Okay, you work hard every single week and month, and for what? So please be careful. That's all I'm saying. There's a lot, and that's not the first story. I've got one of my close friends who lost in one stock over 20-something thousand pounds in one stock, and that one actually went to zero. Like the company basically ceased to exist. It was some sort of a pharma company that was, hot and whatever a couple of years ago, and he's lost all that 20-something thousand pounds. It's a lot of money. 20-something thousand pounds for what? For just some penny stock because some idiot somewhere said it's going to the moon. Look at each company, do your due diligence, make sure you understand what you're investing in, make sure you understand the company itself, what it does, how it does, and make sure it has profits. Don't basically think I'm going to be a millionaire next minute. You are going to lose money, so please be careful. Okay, that story genuinely broke my heart, but at the same time, and it's a lot of money. Genuinely, it is a lot of money that he's lost, but alhamdulillah, he's now in a better position where he's starting to think about long-term plan and what he's going to do. Okay, so what I'm going to do now is share with you guys 5 companies that are undervalued at this point in time, and that is based on the research that I've done on basically Morningstar basically. Okay, so you need to be careful. And again, whenever I've always said to you guys, if I say, with Morningstar valuation is great, but it's not the end of the story. So you're gonna still have to do your own research. and give yourself at least 5 to 10% margin of safety depending on the company itself. So what I'm going to do is I'm going to share the 5 companies with you guys today, and we will use fast graph to also give you perspective, okay, for all 5 companies to see what basically that says as well, and we'll take it from there. And the first company we're going to talk about is one that I've had in my portfolio for a very long time. Qualcomm, 174 billion market cap. It has a narrow moat, and price right now is $158 per share. Dividend of 2.25, which is quite nice. Very low payout ratio, and it is important to buy companies when they have a low payout ratio, because that means they still have some of their net income to give it to us basically, or increase that dividend every single year. This one has done a 5% latest 5-year growth rate of basically 6%, and 21 years of increasing that dividend. So 4 more years this will become a dividend aristocrat. That's elite companies that have increased their dividend for 25 plus years. Annually, you got $3.56, 80% safety, profit margin, return on equity, return on investor capital, really, really good, and $11.7 billion of free cash flow right now. The growth is not there. That's probably why it's cheap. It's probably going to get cheaper if things do not improve. And I remember this company when I was buying, it was at the time where basically this was a negative. The EPS basically and revenue were, but EPS especially was a negative, and I bought quite a bit at that time, and it went up again, and then I sold a little bit of it, and then now we're back again that situation. This is a semiconductors are very cyclical businesses generally. Okay, so Morningstar is saying is about 8% upside from where we are. $170 per share is where they think the price should be. And as you can see, the earnings has been quite stable for quite some time. Then we have a massive jump, then massive drop, and then up again. And then we're going to be flat for the next couple of years. As you can see here, 2025 we're expecting about 15%, but 2026 is only 2%, and 2027 we're expecting only 1% in terms of growth side of things, which is probably why the stock is cheap. But right now, if we look at the forecast moving forward for this company, and we're using based on the estimates that we have here, you can see if you bought this stock right now, you will get about 4%. So your 10,000 will become 10,900 by 2027. So you probably gain about $911 or whatever. If you use the normal multiple for this company, okay, that is earnings yield about 2.55, so the earnings growth rate, but you will be making about 13%. So your 10,000 will be about $13,222. Okay, so that's the first one that we wanted to look at. The next one that we're looking at is Copart. This is basically Copart is one of those companies that a lot of the brothers in the community talk about on the page, on the Discord. By the way, the Discord is free. If you want to click on the link of the description, you can join for free, inshallah. There's brothers who are monitoring. Allah reward them for doing what they're doing, because I haven't got a lot of time, so they've taken care of, they manage it, and they've created a wonderful community, and they're going to continue doing that. And it's free if you want to join and learn basically what other brothers and sisters are doing, inshallah. Okay, so we're looking at the market cap of $47 billion. Moat is basically white moat, which is quite nice, $48 per share right now. They don't pay any dividends. Profit margin, return on equity, return on invested capital is really good. $1 billion of free cash flow right now. EPS is about 12%, expected to grow about the next year, that's 2026. Revenue about 9%, and 17% upside from where we are. $57 per share is where they think the price should be. This one is a very interesting one. And looking at fast graph, as you can see, the earnings has been growing nicely all these years, and it's expected to continue doing that. But completely price is basically engaged from what's happening to the reality of the company, and it's gone up and up and up for no reason other than just basically the company is growing nicely. So they saw quite massive jump around here, and right now it's kind of stabilizing. As you can see here, we've got about 10% in 2025, 2026 about 9%, and 2027 we basically got about 11%, which is nice to see. And as you can see here, forecast moving forward for the normal estimate that we've just seen, if we use the normal estimate, you'll be losing about 23% of your money. So you will have, in 3 years, you will have about 5,700 USD. Now, if you basically use the normal multiple for this company, it's slightly different. It's about 16% basically. according to this. So that's why you just need to give yourself margin of safety, because if you saying, okay, I'm going to use the normal multiple, which is basically what this company has been trading basically over the whatever years, and is going to continue to do that because I can guarantee it somehow, then of course you need to take that basically. And the factor is it's about 17% upside from where we are. It's actually a good thing. So you can give yourself maybe 10%, 15% in the safety side of things. So if you bought it right now, you would still be okay. Okay, that's margin of safety on the top of basically what they've said. J&J is the next one of my all-time favorite dividend paying companies. Very, very stable. I promise you I'll probably own this one at some point again. The reason I sold a while ago is the legal situation that was happening. I think it's still happening, but I really like this because of this, what's in front of you. It's a huge company. It has a wide moat. In dividends are over 3%, which is nice. Low payout ratio. Increases that for basically every single year. For the 62 years, you get basically safety of 99%, and you get $5.20. So profit margin is great. Return on equity is great. Return on invested capital is, really good. Overall, amazing company. Free cash flow of $20 billion, and they expect it to grow about 5 to 10% in between. Sometimes about 5 to 7% per basically every single year for the next whatever years. Revenue and EPS more or less the same. It's expected to be about 6% upside from where we are. $164 per share is where they think the price should be. If I see this, I promise you, if I see this around 140, I probably will buy back, because that will give me enough margin of safety. So just in case that legal situation doesn't go well, then potentially I could sell it and still make a profit. So that's my thought. Don't do it. And again, looking at this, look at that orange line. It's been growing steadily every single year. This is why it's so reliable. Look at this basically gold line as well. That's the dividend growing every single year. We had a bit of a dip in 2020, and then of course it bounced back very quickly, massively, and then from there it became stable, and then it went down a little bit, went down again, then now expecting to grow next couple of years. So you got in 2025 you got about 6%, 5% in 2026, 8% in 2027. So if you were to invest in this company right now as it is using the normal estimate, you'll be making about 9%, which is really good, okay, on basically operating earnings growth rate of about 6%. Now normal multiples for this company, you will be making about 13%. So your basically 10,000 will become about 13,840 USD. So again, another really great company. I really like that one, and like I said, I'll probably buy back if I see it below 140ish. Deckers Outdoor Corporation is another one that I have in the family portfolio. It's currently undervalued according to Morningstar about 13%. It has a narrow moat. They don't have any dividends. Profitability side of things is really great. Free cash flow is decent. They're expecting to grow their earnings about 11%, revenue about 8%, and $120 per share is where they think the price should be. That's about $15 higher than where it is, which is about $105 per share. And again, another great example. Things have been okay and things are slightly increasing, and then all of a sudden look at that price. It's gone up ridiculously high, and then right now we're here. So it looks like it's undervalued because that basically the price line is now below the earnings line and so on. And as you can see here, 2025 they're expecting about 30% growth, and then negative 5% in 2026, and then probably that's why it's done a lot because of the tariffs and all of that madness that's happening. 2027 they expected the earnings to grow about 12%, 15% in 2028. If you went to invest it right now using the normal estimates, you will be losing money. Actually no, you will be actually about 3.5%. Okay, so your 10,000 will become about 11,000 USD. If you use the normal multiple for this one, what is basically normally what Mr. Market likes to trade this company, about 16% from total annualized rate of return. So your 10,000 will become 15,111 USD. And the final company we're going to talk about today is Fortinet, another one that I own in the family portfolio. 80 billion market cap, has a wide moat, cybersecurity company, one of the best out there. We use a lot of their basically technologies in our current place that I work. Free cash flow $2 billion, and they expected the earnings to grow about 14%, revenue about 13%. It's 1% upside from where we are right now. It's about basically that much now, so it's not too cheap. and you will definitely need to give yourself margin of safety. Again, another great company. It's been really, it's been around for quite some time, and things have been great. You know, they're steadily going up every single year. But look at the price. The price has been all over the place, but right now it looks like it's still overvalued looking at this one. And the earnings they're expecting about 2025 about 4%, 2026 about 13%, and 2027 about 14%. Now if we use forecast, for example, and we're using not basically the estimates, okay, as you can see, you will be losing about 27%, so you're losing half of your money basically. So over, that's the total annualized rate of return, but you will have up less than 5,000 USD if you invest in today. And if we use the normal multiple, okay, you have to be careful, that's 42 PE, okay, that you will be making about 10%. So this one seems a little bit overvalued, and the fact that it's just 1% into basically upside from where we are right now, I'll probably wait to see this one drop at least 10 to 15% before I invest. But it's still based on the Morningstar valuation, it basically comes as it has a bit of an upside. Now quickly to show you this part here, so you can post the video from Sharia compliance side of things. These are the standards that I use. I hope you're enjoying this type of content. If you are, don't basically hesitate to join us the Patreon account. Basically send me your portfolios. I really would love to hear from you guys. I've got a few more that I just need to reply to, but if you can share it with us, that would be absolutely amazing. You get access to a lot of things, the family portfolios and so on. And yeah, have a wonderful day. Assalamu Alaikum.